Where do you see the opportunities right now, and how do you, I guess, play this market given the risks of potentially policy mistakes and the rates environment that's changing as well?
Well, I guess in the short term is that this situation is far from resolved, and so the uncertainty remains high. That the situation in Ukraine could quite easily deteriorate a lot further, and so we can see more downside in markets. So right now, it's a case to be cautious. If you are particularly concerned about it, to invest in some hedges like maybe bonds or gold. But obviously, timing it is going to be very difficult. But the history of these sorts of events is that we tend to see a sharp fall, often averaging around 6%, sometimes more, sometimes less, over the space of about 3 weeks or so. Then you get a rebound and a recovery taking place, which then becomes clearly evident after 6 or 12 months. So that's the extent to which I see it as a buying opportunity. Very hard to time these sorts of events, but I think the key for investors is to look for the opportunities it throws up. Obviously, share markets have come down more than 10% globally, and so that will throw up opportunities. Likewise, assets that may have been hit just because of the risk-off tone in cyclicals, I think they will actually benefit over time from somewhat higher inflation and higher commodity prices. They're worth looking at. So it's really a time in the very short term for investors to be cautious, but just to look for those buying opportunities as markets push lower.
What about some of the emerging market opportunities around this part of the world, given there's still some concern about contagion, and certainly when it comes to China, there's some pretty idiosyncratic concerns there?
Look, there certainly are risks in our region as well, and obviously geopolitical tensions with China remain, and to some degree, some would draw links between the situation with Ukraine and the situation with Taiwan. Those links can be taken a little bit too far, but I think the broader picture that we're looking at here is still one of global recovery. I don't think that the situation in Ukraine will derail that recovery. It will threaten higher inflation and threaten growth in the short term, but the broad situation is one of global recovery. And emerging markets, Asian share markets, normally benefit from global recovery. And so in that sense, I'm reasonably positive about the outlook for Asian shares generally over the next 6 to 12 months.
There seems to be a growing expectation that the loosening of monetary and fiscal policy in China could be give the next leg up for Asian markets. Are we a little bit too optimistic about what Beijing might do?
Perhaps, and that's what a lot of people say, but by the same token, China is ahead of much of the rest of the world. It eased perhaps more aggressively, or they went into the coronavirus crisis ahead of everybody else. They recovered ahead of everybody else. Obviously, they announced stimulus and support for their economy earlier than other countries did, and then they started to remove that support and stimulus earlier than other countries did, and it showed up in the slowdown in Chinese growth through last year and also in Asian growth through last year. So if we are moving into a situation where China starts to take its foot off the brake, which seems to be the case, then we should start to see that I think that will benefit Asian share markets through the course of this year. But it's not going to be as simple as it has been in the past. The Chinese easing measures are not going to be as stimulatory as they were in the past. I think it's more an easing of the brake and maybe touching the accelerator a little bit, but it's not going to be an overwhelming stimulus like in times past.
Is it still a sort of the best that we can hope for when it comes to the Chinese markets, given that other markets now seem to be moving in the opposite direction? We saw the RBNZ hiking rates. We have the rate decision coming from the BOK today as well. What are you watching in terms of opportunities, especially as you see this diverging policies between central banks?
Well, the problem in the short term is that central banks have to respond to the surge in inflation, which they're seeing before them, and which has gone on for longer than they expected and has taken inflation higher than they expected. But I would also be watching for signs that inflation might start to slow on a, say, 6-month horizon, at least by the second half of this year. There are some signs, if you look at the business PMIs that came out earlier this week or in the last few days, that supply delivery times are starting to improve. It's still a bit mixed in terms of the pricing components of those surveys. Some still upwards pressure on selling prices, although there are some signs that input prices may be starting to slow. I think, to me, that's the key to watching for those supply side constraints starting to abate. Transport costs shipping issues, semiconductors, and so on. And there are some signs of light on that front. But obviously, in the near term, central banks are still going to be raising rates. But I reckon through the second half of the year, we might get into a phase where some of the inflationary pressures start to abate, and that will take some of the pressure off central banks. And there's a good chance that will combine with what might have been several months worth of easing in China to give us stronger markets into the end of the year. And then that in turn aligns with hopefully the Ukraine situation settling down and markets recovering from the turmoil that Ukraine's caused. But the history has been that this is the midterm election year, and often midterm election years in the US are rough. And it's no surprise that's what we're seeing right now. And we did have a very good year last year, so to some degree it's payback of what we saw last year.